Good day, students. Today we will continue with part 3 of business combinations. Just to recap as to what we've done in part 1 and part 2. Part 1 we went about identifying the parent-subsidiary relationship that exists because of control. Part 2 we then talked about the consolidation procedures when control does exist over the subsidiary. Part 3 now, which deals with measuring the business combination, is what we will start with today. Just to get a brief overview of what IFRS 3 business combinations deals with. Firstly, it defines what a business combination is. Secondly, it identifies the parent in the transaction. Thirdly, it measures the cost of the entity that we're acquiring. And fourthly, it says, and it tries to measure the fair value of all the assets and liabilities assumed as part of the subsidiary. Those amounts we then use to calculate what is referred to as goodwill or the bargain purchase at acquisition date. When we have goodwill, we recognize it as a separate asset in our consolidated financial statements. When we have a bargain purchase, we recognize it immediately as income, but we'll get to that a bit later. Coming back to our slides. So what are the learning objectives? One is define what a business combination is. And secondly is to account for the business combination. What is a business combination? It's basically a bringing together of separate entities or businesses into one reporting entity. And it's done so by the parent company, the acquirer, obtaining control over one or more businesses, which we refer to as the acquiree or the subsidiary. The consideration for the acquisition of the subsidiary may be paid in equity, cash, or cash equivalents, or other assets. So how do we go about accounting for the business combination? The 5 following steps will be used in identifying in accounting for the business combination. Step 1, identifying the acquirer. Step 2, identifying the acquisition date. Step 3A, recognizing identifiable assets and liabilities. Step 3B, step 4, measuring the identifiable assets and liabilities. In step 5, step 4, recognizing them and measuring goodwill. So identifying the acquirer. The acquirer is the company who gains control over the other entity. The cost of the business combination. So the acquirer shall measure the cost of a business combination as the aggregate of the fair values. And it's important that we recognize here that most of the reference to costs in the business combination refers to fair values. So it's the fair values at the date of exchange of assets given up or liabilities assumed and equity instruments issued by the acquirer in exchange for control of the inquiry. Importantly, the fair values of the assets given and liabilities assumed to acquire control over the inquiry. Plus, and this is important, any directly attributable cost to the business combination. So, any cost incurred as a direct result of the intention and the execution of the business combination, those costs can be included as part of the cost of the acquisition. I said can be, it should actually be, should be included. So let's look at example 1. So example 1 deals with the basic costs of a business combination. So it reads as follows. SMEA acquires 100% of the equity interest in SMEB, a company operating a clothes retail business. retailing business in exchange for. So this is what SMEA has paid for the 100% shareholding in SMEB. Cash of 10,000 paid on the acquisition date. And that's fairly straightforward. 10,000 Rand cash paid. Second item, an office building acquisition date fair value measured using the price per square meter for the building derived from prices in observed transactions involving similar buildings in similar locations equals 50,000. The important thing to remember here is that we're looking at the fair value of the asset given up, not the carrying value, not the cost, but the fair value. So based on observable prices for similar buildings, the fair value of the office building given up is 50,000. The third item, 2 gold bars, acquisition date fair value measured using the spot quotation by the London Bullion Market Association equals 1,000 Rand per gold bar. So 2 gold bars at a fair value each of 1,000 Rand. Total purchase amount of 2,000 Rand. 10% of equity instruments of SMEA. Share capital of SMEA consists of 1,000 ordinary fully paid shares. The fair value of each at the acquisition date was 10 Rand each. The fair value was measured using an income approach, discounting cash flows using market participation or participant assumptions. Again, 10% shares at a fair value of 10 Rand. 1,000 shares at the fair value of 10 Rand gives us 1,000 Rand fair value of equity of SMEA given up to acquire interest of SMEB. The last item, 1,000 shares in a third party entity C. So these are shares that SME has in entity C. Investment, exactly, that SMEA has in entity C. Entity C's shares are actively traded on the London Stock Exchange. Acquisition date fair value equals 6 Rand per share. So again, what is the fair value of the investment given up to acquire SMEB? 6 Rand times 1,000 shares gives us 6,000 Rand fair value for the shares given up. So let's look at the cost of the business combination in total. So we have the 10,000 Rand immediately paid. We have the fair value of the building given up, 50,000. We have the fair value of the 2 bars given up, 2,000. We have the equity instruments of SMEA given up, 10,000. And we have the equity instruments of entity C given up, 6,000, which equates to a total fair value of the consideration paid for the business acquisition of 78,000 Rand. Importantly to note here, deferred payments. Deferred payments happens when we acquire the business today, but our intention is to only pay on some future date, normally about a year's time. And if that is the case, we are required to discount those future payments to its current present value. But we will deal with an example a bit later. Look at example 2, which now deals with exactly the deferred payments. So when settlement of a cost of the business combination is deferred, the fair value of the deferred component is measured at its present value as at the date of the acquisition. Exactly. So example 2. So on the 1st of January 20X1, SMEA acquired 100% of the equity interest in SMEB in exchange for cash of 30,000 Rand to be paid 2 years later. Again, to be paid 2 years later on the 31st December 20X2. So what is important to note here? The acquisition date was the 1st of January 20x1. The payment date will only be on the 31st December 20x2, which in essence is 2 years later. The SMEA's incremental borrowing rate is 5% per year, which means that if it had invested the money, it would earn 5% return. The cost of the business combination is 27,211 Rand, the fair value of the consideration to be given, which is essentially the 30,000 Rand paid in 2 years' time, discounted back for 2 years at the incremental borrowing rate of 5%, which represents the present value of the 30,000 Rand deferred payment by 5% over the 2-year period. So I recommend that you work through this example again just to get a good understanding. So let's go to example 3. So example 3 now deals with those directly attributable costs, which we refer to as acquisition costs. So what are directly attributable costs? As indicated, it is those costs or are those costs which are incurred as a direct effect of the business combination. So the question is, if we had not gone about pursuing this business combination, would we have incurred those costs? And if the answer is no, then it is a direct cost as a result of the business combination. So let's look at example 3. It says SMEA acquires 100% of the equity interest in SMEB in exchange for cash of 30,000 Rand. In addition, SMEA paid the following costs that are related directly to the business combination. So we paid advisory costs, we paid legal costs, we paid accounting costs, and we paid valuation costs. The total sum of which is 2,000 Rand. So the question is, what is the total cost of this business combination for the acquirer? It is the 30,000 Rand cash paid plus the directly attributable costs of 2,000 Rand in total, which means then that the cost of the business combination is actually 32,000 Rand, which includes the cost of the consideration paid, 30,000, and all the costs that are directly attributable to the acquisition. That's where we'll stop right now. We'll continue with the rest of the sessions, but